When are we supposed to tax?
When are we supposed to tax? Because income tax is calculated annually, but business incomes and expenses span often multiple years. So this is why we have a timing issue. When to tax, we have three solutions. Immediate deduction in the current civil year, capital cost allowance, which we'll see later, or deduction on disposition. Cost impacts future profit, we have three solutions. Immediate deduction in the current civil year, capital cost allowance, which we will see later, or deduction on disposition, meaning a part of the asset, when it's sold, we tax it. Well, why do we even have this problem? Well, because, civil years were made to remember when is reading week and when you'll finally finish law school, not to know when you're gonna get taxed. Another reason is because taxpayers are smart and they know that $1 today is worth more than $1 tomorrow. Therefore, when you accelerate deductions, you get them sooner, and when you defer income, you recognize it later. It provides a significant benefit for taxpayers. This is the key to understand why we have all these issues and these solutions.
The legal framework, current versus capital expenses. As we're sitting right beside Canada Revenue Agency, we need to talk about some of the income tax rules. First, we have section 18(1)(b), the general rule. No deduction is allowed for, quote, any outlay, loss, or replacement of capital. This creates a presumption that capital expenditures are not immediately deductible. Section 20(1)(a), the exception. A taxpayer may deduct such part of the capital cost as is allowed by regulation. This is the legislative authority for the capital cost allowance, or the CCA system, which allows for the gradual deduction of capital expenses over time. So I know that you law students are really lazy and you're just getting back from reading week. So to save you the mercy of having to hear the CRA's criteria for distinguishing current versus capital expenses, I'm gonna have a very easy table that comes up in the next 3 seconds. Go watch it. So you'll notice we're actually not at the Supreme Court of Canada for this section of our video where we talk about case law. So we didn't have the finances to actually go to Ottawa for the Supreme Court section of this video. But we have the next best thing, Montreal's most prestigious, most incredible institution, the Palais de Justice. Follow us now on this journey.
So the landmark case about when to tax is Johns Manville Canada Inc. versus the Queen. And again, we have a taxpayer who didn't want to pay. Why? Because he was operating a massive open pit asbestos mine in, guess where? Asbestos, Quebec.
I haven't been citing from Johns Manville recently. Part of a classic, the classic discussion on capital versus income.
Johns Manville Canada versus the Queen. Let's start with the basic facts of the case. It's a taxpayer business. Johns Manville Canada operated a massive open pit asbestos mine, and you guessed it, Asbestos, Quebec.
The issue of capital versus income is well litigated. It's current. I think the bottom line is if you're in business, you're taxed on profit.
The operational problem of the issue, in order to mine safely and operationally, the walls of the conical pit had to maintain a very specific angle, or the angle of repose. As the pit deepened, the surface mouth had to widen in order to maintain its slope.
Because you're taxed on profit and not some other base, you need to think about, just because I'm making revenue now doesn't mean it should all be taxed, because I need to do a certain number of things. In this particular case, it's a mining company. They needed to secure land around the mine.
The taxpayer in this case was forced to annually purchase more peripheral land around the pit's rim. This land did not overlay the ore body and had no actual mineral value.
That was, not necessarily have ore in it, didn't necessarily have the mining properties, but it was clearly necessary for a business.
The nature of the assets itself, the purchased land was actually stripped of soil and or rock, effectively consumed. As the pit widened, it became part of the sloped wall and gradually disappeared. As a result, no enduring asset remained.
When you're doing something in a commercial sense, and when you're doing it, it's not personal, it's not casual, it's for a business purpose. The test usually should be that's deductible.
This was a recurring annual operational necessity for almost 40 years to avoid catastrophic landslides, which had actually occurred in the past. For example, 1971 and 1975.
It's elevated to a level of commerciality. Now, then the other side of it is, well, is it more proper to amortize that over the life of the property?
And when it comes to the actual financial scale of the issue, the cost of these lands purchased represented about 3% of the cost of sales over an 8-year period overall.
There's no great answers to it, but the jurisprudence, is sort of strikes this balance between the upfront expense and the amortization.
The legal question was, were the annual costs of purchasing the peripheral land as a current expense or deductible immediately, or seen as a capital expenditure that must be capitalized?
I think one thing that often gets lost in this is whether someone is recognizing income or recognizing expense. Johns Manville is incurring expense, but on the other side, one is recognizing revenue.
Going over some of the actual judicial history, at the trial court, Gibson stated that the expenditures were actually current expenses incurred as an integral part of the mining operation overall and consumed in the actual process.
Shouldn't underestimate the other side, being Canada Revenue Agency usually, or Revenue Quebec, might take a different position on the same fact depending on whether it's revenue or expense.
At the Federal Court of Appeal, Judge Ryan actually reversed the trial decision and held the expenditures were capital because the purchased land was, quote, incorporated into the operating structure of the enterprise.
Like on the other side, it could be a capital gain, whereas if it's on income account, it's fully includable.
The Supreme Court of Canada, Judge Esty, allowed the taxpayer's appeal, reversing the Federal Court of Appeal, held that expenditures were current expenses.
But there's some good reasons why, and this is why the balancing act that comes up as well. Is there an enduring benefit?
We're not even at the Montreal court anymore. We made a move. We're now at the Cour d'appel du Québec. And maybe even this video is sponsored by Tourism Montreal. You'll never know. Reasoning and the key legal principles. Let's start with the court conducting an extensive review of common law tests, emphasizing that no single test is paramount and, quote, a common sense appreciation of all the guiding features is actually required.
But, CCA contemplates capital cost amounts, contemplates the amortization of an asset. And if there's nothing left and there's no enduring benefit, the one-time expense, and, we also think about, is it, do I have to pay it now? Do I have to incur it now? Or is it contingent? It's not contingent and it's not refundable and it's one time. These are all things that fall in favor of immediate deductibility. So
a once and for all test was seen as being not decisive, as an expenditure can actually be recurring and still be capital. Key for this is the enduring benefit, the business structure overall. Another element is the subject matter is not actually determinative. The fact that the expenditure was for land is not controlling and can be a current expense depending on the actual nature of the trade itself. Separate and distinct asset test. The court considered but found to be over-inclusive for minor or consumed items.
No real critique here of the case. If you're in a commercial environment and profit is the way to tax, you necessarily have to get into these considerations. If you were going to go change the tax base and just tax on the basis of revenue, you don't need to do all this because it doesn't matter.
The court favored the approach from BP Australia Limited and Holmstrom's. Classification, quote, depends on what the expenditure is calculated to affect from a practical and business point of view, rather than upon the juristic classification of legal rights.
You don't see it here, but you'll see it, for example, in in Canderel. What does the accounting, what do general accepted business principles tell us how we do this, and how does it guide us?
So now we're going to go over the 10 factors supporting the current expense classification. Follow me. 1. The purpose: to remove a current obstacle to operation, not to acquire a capital asset. 2. Recurrence: annual, integral part of day-to-day operations. 3. Cost structure: a constant, discernible element of production cost. Number 4. Lack of intrinsic value. The land was actually bought for the location only, not the value, and was, quote, consumed. Lack of an enduring benefit is number 5. The benefit was actually transitional. Similar expenses were needed annually to continue. Number 6, 5 plus 1, is the transitional nature. The, quote, asset, the pit wall location, was temporary and disappeared. Number 7, the historical necessity. It incurred for 40 years and was essential to continue the operations. Number 8, no capital relief if capitalized. The land was not eligible for CCA as it's not in Schedule B. Or depletion allowance, seen as no minerals. Capitalization would yield no tax relief for a necessary business cost. Enhancement of operations is number 9. It did not add to the actual ore body, increase its capacity, or relate to a productive asset.
Last one, number 10, is the proportional cost. The cost was small, less than 3%, relative to the overall operating expenses.
What was the conclusion? The Supreme Court held that the expenditures were deductible current expenses. So the appeal was allowed, and the matter was returned to the minister for reassessment on this basis with cost to the appellant. But what you need to remember is the overarching principle from Johns Manville, which is that the capital/income distinction is a fact-specific, holistic inquiry. And I quote, "The courts can do little better than form an opinion which way the balance lies."
Any modern challenges, for example, with AI or cryptocurrencies, or makes you changes the case by cases? And
You mean, should we be thinking about, for instance, the difference between a bricks and mortar situation? I think the same concepts apply, right? And they are fairly flexible. It does get challenging. For example, if you're talking about cryptocurrency, or is someone trading in cryptocurrency? Is someone a past investor? And if someone is trading but a bad trader and making losses, the minister may take the position that's not a business and therefore not deductible against other income. Intangible property that's not a mine can be harder to understand in terms of rights, particularly cryptocurrency, which, is it property? Is it entirely contractual? Or things like crypto, the agency takes a while to understand it. There's not you're looking at income tax, but there's other areas as well, like GST, for example, and looking at whether things should or ought to be taxed. Location is difficult. Can be difficult when it's not like a mine. If Spotify is charging for something that's housing in Sweden, should it be charging GST? I mean, there's a special regime now, but they're constantly challenging, and it's great to think about these things. So